Hi, what I want to do now is to focus on the accounting requirements in IAS 21, AASB 121, which address the translation of financial statements denominated in a foreign currency. Just so it's clear what we're talking about here, if you have an overseas operation and it prepares its financial statements in a currency other than the functional currency that's going to be of its parent, or the presentation currency which is going to be used in its financial report, then before you can consolidate those financial statements they need to be converted into a common currency. So that's what we're dealing with in this part of the standard. This is clearly identified when you look at the scope of the standard, which is outlined in paragraph 3, and what it clearly outlines here is the idea that what we're focusing on here is that before you can aggregate sets of financial statements, either through consolidation or equity accounting, they need to be accounted for in a common currency, and this is the process of converting financial statements from one currency into another. There are once again some key definitions here. A foreign operation is defined as something which is taking place outside the country of which the reporting entity is located. A functional currency is the currency in which the general ledgers are maintained, the country maintains its records in. A presentation currency is the currency that's used in the financial statements. A presentation currency will typically be the functional currency, but there are going to be circumstances where this is not the case, and a good example of this is, say, BHP Billiton, who might have as a functional currency the Australian dollar for the Australian entity, and GBP for their UK operations. However, what you see in their financial statements is they present their financial statements with a US dollar presentation currency. The reasons for this are probably pretty straightforward. They're a resources company, most of their resources are priced in US dollars, and it makes their financial statements much more understandable. The closing rate is, as previously defined, it's the exchange rate applying at year end. And when you have financial statements, you're going to have a net investment in a foreign operation. So how does translation work? Well, quite simply, translation is addressed in paragraph 39, and it says that at year end, assets and liabilities shall be translated at the closing rate at the date of the financial statements. Income expenses shall be translated at the exchange rates applying at the date of the transactions, although practically what most people tend to do is they tend to use averages. So that's just an aspect of being practical. Exchange differences are recognised in other comprehensive income. So that's it. It's pretty straightforward. There's not much to be said in relation to accounting for foreign currency translation. It's quite a mechanical process. There are some challenges that exist with this process of converting financial statements from one currency into another. The rules may at times not appear to be totally logical. So for example, when you're calculating cost of goods sold, you may have the closing inventory recognised at the average exchange rate applying at the date when the inventory was acquired. That's in the income statement, but when you look at the balance sheet you'll see that it's converted at the closing rate, two different rates. There are also issues with depreciation and in other areas. Can I suggest that the issue here is just a set of rules which you'll learn to follow, and please don't overthink it. In terms of how the differences arise, it's probably quite good to think about this, as I think it will cement how the rules work. Exchange differences are going to arise for two main causes. If we think about a set of financial statements as having an opening balance sheet and a closing balance sheet, net assets, book value of equity. Now, last year we converted what was last year's closing net assets, which is this year's opening net assets, we converted it at last year's closing rate. So one cause of difference is going to be that we're going to convert our opening net assets, which was converted last year at the opening rate for this year, And at the end of the financial year, those same net assets are going to be converted at this year's closing rate. So that's going to represent one source of exchange difference. The other source of exchange difference is going to rise because of how closing net assets have changed. Now, to simplify things, I'm going to assume that there's been no equity issues and there are no dividends. It's not critical, but it just makes it easier to think about it. How does opening net assets change? Obviously, it changes through profit which is earned during the year, doesn't it? And what we're going to see is that change in net assets, in the income statement, it was recognised at progressive average type rates, whereas in the closing financial statements, or at the year end, it was converted at the closing rate. So the second cause of differences is going to be exchange differences, which are recognised as a consequence of items being recognised in the income statement as at sort of an average rate, whereas in the closing balance sheet those changes are converted at the closing rate. So that explains the basic cause of the differences. There's two main types, and that will help you to understand the rules which have been applied here. The disclosure requirements are again quite minimal. Essentially, you have to identify the exchange differences recognised in other comprehensive income, translation gain, foreign currency translation, gain or loss, and there is actually some significant disclosure on the presentation currency and where the presentation currency might be different from the functional currency, but that's just trying to provide more rationale for it. So it's a pretty straightforward process, but it is probably a little bit too mechanical.